let's go ahead and talk a little bit more about petty cash. We introduced it briefly last time, but what kind of an account is petty cash? It's an asset, has value. It's a small fund we keep somewhere in our business for those small miscellaneous little purchases that we don't have to write a check for. So we're just going to give them money from this container, drawer, whatever we set up. And what you do when you establish petty cash is you write out a check for the amount that you want to keep in petty cash. So what do you think an amount for a business might be?
Depends on the business.
Totally dependent on the business. If it's a really large business, this is having things come in all the time that have to be small amounts, it could be $1,000 or even more. But a small business usually wants to leave it low, just lesser chance of money just walking away that way. So we're going to establish it by making a check out to cash and cashing it at the bank, so we have that source document, the check, and then we're going to put it into our petty cash fund. So every time we have to make a payment out of it, are we going to journalize that? Probably not. You're going to wait. Because otherwise we could have a lot of little tiny journal entries. Instead, what we're going to do is we're just going to fill out some kind of a system, and that's established by the business. A lot of businesses do something called vouchers. They'll fill out the voucher saying what it's been paid out for and attach any receipts to it if there are any. And that way we just keep track of the vouchers until our funds get low. In which case, once the funds get low in petty cash, we're going to do something called replenish it. And what are we going to replenish it to? Whatever we established it at. So if we started it at 100, we're always going to replenish it back up just to 100. Okay, is that clear? You're always going to replenish it back up to what you established it at. The only time that's going to be different is if you find that that petty cash amount is not meeting the needs of your business. Maybe you're going through it in 3 days. Probably you need a larger petty cash fund, so you're going to want to increase it. But for right now, we're just going to talk about the procedure for it, and then we'll do some journal entries for it. Here's an example of a voucher. So someone comes to you and says, I need $5 to go buy drinks for a meeting that's going on. So you're going to have them fill this out, usually requires some signatures or at least initials, and then you're going to give them the $5. And in place of that $5 that you've given them, you're going to put this voucher in that petty cash box or drawer or whatever it is. And then later this will be used to journalize the information as to the use for that money. Now, when your petty cash fund gets low and you want to replenish it, that's when you need to record all the information from the vouchers or something else, and something that we're going to learn to do both in this chapter and then later in your mini practice set. And that's what's called a petty cash auxiliary record, which just simply shows you where all the money from petty cash is being dispersed. And you just keep track of it all in the record, and then when you go to replenish it, you know what it's been done for, and that's when you journalize. So we're going to go through that process here in a minute. But two different methods. You can use both. You can use a voucher system and then record it in the petty cash record just as a double check. But it's from one or both of those that you decide on how to record the expenditures from petty cash. Now, if someone came to you for petty cash and said, okay, could you give me $200 to go buy a piece of equipment, what are you going to say? No. That's not the intent for petty cash. It's for those small miscellaneous expenses, not for something like that, in which case you would just simply write a check. Now, let's take a look at some journal entries regarding petty cash. The first one shows the establishment of petty cash by recording it in the journal. And what is the debit showing? Okay, in which account? Petty cash. Because petty cash is an asset, to establish it, you debit petty cash account for the amount that you're going to put into it, and you credit cash. Make sense? You're taking money out of your account and putting it into a drawer or a box. Now, the only time you impact that account, petty cash, is when you establish the fund and when you increase or decrease it, but not when you replenish it. Again, I repeat, the only time you impact the account petty cash is when you initially establish it, or when you want to raise the amount that you're going to keep in it or decrease it, but not when you replenish it. So petty cash is going to remain at 60. You're going to expense out the money that gets taken out of it, but petty cash itself stays the same. So, look at the next journal entry up here, showing at the end of the month, you're going to take your vouchers or your petty cash record, and you're going to see where all the money that was spent went. And that's when you're going to journalize it, when you decide to replenish the fund back up to the $60. So, what did you use that money that you spent from petty cash for? What's it showing? Postage expense, delivery expense, cleaning expense, and miscellaneous. If it doesn't fall in an expense, you put it under miscellaneous. And the total of all those expenses, you write out a check for cash, go and cash it, put it back in your petty cash. So is petty cash changed? No. But does your business now show the expenses that has incurred as a result of spending the petty cash money? Yes. So replenishment gets journalized this way. Expense out all the items that were dispersed from petty cash, and then write a check to replenish that account. Okay? There could come a time when the amount of cash does not equal all the expenses recorded in either your record or your vouchers. How could that happen? Someone didn't make out a voucher. They just went in and said, oh, I'll do that later. Took a 10 and nobody thought to record it. So there are times when you could be short when you list up all your expenses, or you could be over. So we're going to show you how we're going to go about recording both of those. It's an account called Cash Short and Over. If the ending balance in this account is a debit, it's treated as miscellaneous expense. Does that make sense? A debit would be an expense because all expenses are debits. If cash short and over, however, shows a credit balance, maybe someone gave the wrong change to someone or shorted them on a payment, and therefore you could have more money in there than you should, in which case that's going to be called probably miscellaneous income or a credit. Revenue accounts have credit balances, so that makes sense. Now, we're not going to use this very much in this class, but I'm just want you to be aware of this account and how it's impacted. So here's another journal entry for a petty cash account. Notice at the top, again, that's the establishment of petty cash. Debiting petty cash, crediting cash. The replenishment from our vouchers or a record shows what you spent your petty cash on. And again, delivery, general, office repair, and because it didn't balance with the amount we needed to get it back up to where it was, we have something called cash short and over of $6. Based on what I just told you, if cash short and over is being debited $6, is that an additional expense or is that additional money we found? Good. Because it's a debit, it's additional expense. And then the cash amount is $78. Now, how do we know we were short or over? Right, because all the expenses from your vouchers or your record added to what's left in petty cash doesn't equal what you started with, in which case you're either short or you're over. So they must agree. So you have to find out what you have left and see what you've spent, and hopefully if they both add up to what you started with, you're okay. If not, you have something called cash short and over. Okay? And again, you're not going to use it very much in this class. And one more thing before we do a little bit of work on some of these things from today, and that is a brand new account. In the past, our revenue accounts have been for service businesses. And what kind of revenue accounts did we have? Service fees, delivery fees, commissions earned, things of that nature, because we provided a service to someone. That's how we received our income. From now until the end of the term, we're switching gears. We're now going to be what's called a merchandising business. So we're going to sell a product. Therefore, fees earned and all of those commissions earned and service fees, you're not going to see anymore. Instead, every time we sell our product, our new revenue account is going to be called sales. And revenue accounts have what type of balances? Credit, just like the ones before. So if you sold something for $500, a product for $500, what would be your journal entry? Cash debit, sales credit. Make sense? Cash debit, revenue account called sales credit. It actually makes it a little easier for sales because you know what the revenue account is named. Unless your company is set up to where you have more than one category of product and you might have a couple different identifying sales accounts. But sales is our new revenue account for merchandising businesses. Okay? Any questions?